So let's take a look at exercise 7-1, in which we'll work on a journal entry to record the purchase of land. But before you do the journal entry, you need to ascertain what amounts you're going to include in the cost of the asset. So with all long-term assets, we'll start with the purchase price, and then we'll look at all the other information. So let's read the exercise. Here we are told that we have McCoy's Fish House that purchases a tract of land and an existing building for $1 million. Now our objective is to find the original cost of land. That's what they've asked us to do over here. We have a land and building. So let's see what's going to happen next. The company plans to remove the old building and construct a new restaurant on the site. So we are not worried about this building because it's going to be demolished. So all we're worried about is the cost of land. So I will start with the first item. And the first item I'm going to put down is the purchase price. Obviously, that's the starting point, the $1 million. Now let's continue reading. In addition to the purchase price, we pay closing costs that includes title insurance of $3,000. Now, always what we need to think about is these additional costs that you incurred, were they necessary for the acquisition of the asset, to put the asset into use and in place? So I have to pay that title insurance. So yes, I'm going to add that as well. The title insurance is $3,000. Let's continue reading. The company also paid $14,000 in property taxes. Now the property tax, if it is for the current or the future, then it's just a regular expense. Let's see what they tell us. It includes $9,000 of back taxes. So I can include in the cost of the asset as long as it's back taxes. The previous owner did not pay taxes, and there's no way I'm going to get the title unless I pay those taxes. Well, either the owner has to pay it, or the buyer has to, the new buyer will have to pay for it. So since I have paid for it, I can add it to the cost of the asset, only the $9,000. So of the 14, $9,000 is going to be added to the cost of land. The remaining $5,000, it's going to be expensed in the current year. Then we are told that shortly after closing, we pay a contract of $50,000 to tear down the old building and remove it from the site. All the monies I spend to get the asset, that the asset is land, to get it ready for its intended use, I intend to build a new building. So cost of demolition, I add it to the cost of land. Now, I got lucky. I was able to sell some of the salvage material from the old building for $5,000. Who knows, someone wanted to buy some of the stuff that I was getting rid of. I got $5,000. So to the extent I got some money, this is cash inflows, it's going to reduce the cost of my asset. So the $5,000 that I received, I'm going to subtract it from the cost of the asset. And then let's continue reading. I also paid $11,000 to level the land. Again, I'm getting it ready for its intended use. So I add the cost of level the land, the $11,000. All this put together is going to be the cost of the asset, and the asset here is land. So in my journal entry, I'll have land debit, $1,068,000, cash credit. I paid cash to various people, but all of that gets debited to land. The $5,000 for property tax in the current year, that journal entry will be property tax expense debit, cash credit. So remember, land is an asset, long-term asset. It sits in my balance sheet until I sell it. I'm not going to do anything to this cost. The original cost stays what it is, which is why it's so important that we identify which ones we can add to the cost of land. So once again, for long-term assets, our starting point is always going to be the purchase price. It's called the purchase price or the invoice price. That's the starting point. And then you have to decide what else was necessary for me to incur in order to bring this asset to its intended use. Any one-time expense that I incurred over here, I will include those over here. So once again, the cost of land, this is going to sit in my balance sheet. The property tax expense for the current year, that goes into the income statement. So with that, we'll move on to our next exercise. in a couple minutes.